Webinar presented by Double N Advisors, Pangea Business Solutions, and Alliant Insurance Services. Over the next hour, you will hear from 3 experts in this field, Carl Versella, Chris Caruso, and Paul Grassi. At this time, I'm going to turn it over to our presenters. Carl.
Thank you, Gina, and welcome attendees for joining us in this 3-part series. This is part 2, concentrating on relationship management and due diligence. Here are the topics that we're going to cover as part of today. And I'm going to go right to our presenters. I'll introduce myself and then hand it off to Paul and Chris. I am the founder and CEO of Double N Advisors, which is a management consulting practice, and also been in a variety of different firms, both on the buy and the sell side, including Morgan Stanley, Credit Suisse, Tiger Management, and Goldman Sachs. Paul?
Thank you, Carl. My name is Paul Grassi. I'm a senior VP and shareholder with Alliant Insurance Services. We are a top 10 ranked insurance brokerage in America. My background is in accounting. I maintain a non-practicing CPA license in the state of New Jersey. The entire focus of my practice is in asset management. Prior to joining Alliant in 2017, I ran the hedge fund practice for Wells Fargo Insurance Services. Chris?
Thanks, Paul. Hi, I'm Chris Caruso, founder and president of Pangea Business Solutions. My background, I was 30 years in the banking business, mostly at Morgan Stanley and Deutsche Bank in various roles, including institutional operations, prime brokerage. I've been in the prime brokerage hedge fund business for 20 plus years. I founded Pangea in 2012 as a counterparty risk consultancy. We have 3 main product lines: advisory, due diligence, and training. Carl?
Thank you, Chris. Let's recap what we did in part 1, which we talked about the fundamentals and evolution of counterparty credit risk management. We talked about the goals. We're going to reiterate and recap those. We talked about the people and process and technology impacts of a solid CCRM program. We went through the history and evolution and the lessons learned of how counterparty credit risk management has evolved. And we also went through the functional areas of impact within an investment manager's organization. We talked about counterparty documentation, which is part of the fundamentals of understanding where your risks lie. In part 2, which is today, we're going to focus on relationship management and due diligence, and it'll be broken out into 4 parts. The first part being how we communicate and report both to and fro to our counterparties, the due diligence that we need to perform on counterparties, and the due diligence that they need to perform on us. Relationship management, a big part of the equation, and establishing who your providers are and who those relationships are in various disciplines within the counterparty. And finally, we're going to talk a little bit about counterparty metrics and what a firm should be tracking, looking at, managing on a periodic basis. Just briefly, we'll talk about part 3 in the next webinar, and it'll focus on putting all of this together. How do you monitor the credit metrics and decision process? What are the relationships that you need to monitor? And how do vendors play a part in the whole equation of an effective counterparty credit risk management program? A recap of the goals of a solid CCRM program. This goes beyond knowing who your coverage is, but it also goes to the operational expertise, the service capabilities, and the metrics. We'll touch upon that. Obviously, understanding and managing your liquidity, optimizing your financing and leverage. Be informed and be proactive in how you communicate and know the metrics. Again, we'll cover a little bit of that today. And transparency is a two-way street. This is not just about providing information to the counterparty, although extremely important. It's also receiving information from the counterparty so you understand how their service levels have changed, what they look like from prior experience, how the relationships have changed, et cetera. Number 6 is really to be in the best possible position with counterparties to win. That starts with your counterparty documentation, but it also starts with understanding who those relationships are, who those people in those firms that you have strong relationships with. Having optionality and exit strategies for certain events. We'll talk a little bit about having backup providers and what that means. Providing what if type scenario, credit scenarios, and obviously providing periodic management reporting to aid in the decision process. That's a recap of what we feel our goals. The first topic we're going to touch upon centers on communication and reporting. And there are 3 main facets to this that I think are extremely important for everyone to understand. First and foremost, who do you need to know at your counterparties? And this is an important portion of the whole equation because senior relationship managers and client service reps, and even talking to the treasury and collateral management guys and gals is important. But all of these people are important in the CCRM relationship management program. Understand what is important to them, understand what their perspective is, especially when it relates to the credit risk officers, the heads of prime brokerage, the trading groups that you're involved in, how do they understand and know your business? Get to know them all. And reporting is another component of this, and it's about getting a rhythm and a timing. What is the frequency of our reporting? How do you, what kind of information are you reporting on? What kind of credit disclosures are required of you, whether it be leverage gearing or the number of counterparties extending credit or your gross assets versus your net assets? Be cognizant of the fact that in today's world, you'll probably be getting, if you haven't already, more questions on what you're doing with other counterparties. And that's not only a direct result of what's happened recently with a few family offices and hedge funds, but also it's good credit risk management process on the counterparty side. So if you haven't been asked these questions, as you get larger, you'll probably get those questions asked. Conversely, understanding what information should be disclosed to you is equally as important. What changes in management have occurred? How has leverage extension changed? What is the legal entity structures that you're dealing in some cases, legal entities may change and business may morph into sub-entities. How do we understand that and know what's going on in the counterparty as changes occur? And the last piece of the communication reporting cycle is the functions that you need to perform. No one likes surprises. No one likes to hear that they didn't know about something occurring or happening, or news that they've heard from third-party sources and not from you guys. It's important to get ahead of the story. I can't stress this more because invariably developing strong relationships when there's good news and bad news about your business is important to communicate to some of the players at the counterparty side, especially the credit risk officers, your senior relationship managers, et cetera. No one wants to see surprises. No one wants to hear about them. Let's make sure that we're ahead of that story. There is also the need for periodic due diligence. And again, major events that need to be potentially disclosed, projected increases or decreases in net asset value or ownership changes within your organization, strategy changes or litigation events that have occurred. All of these things we need to be focused on because this is at the heart of what credit counterparties are going to be looking at. The other thing to think about is doing a peer group assessment. How do you look to your peers and vice versa? This is something that there are a number of technologies out there, and there's a number of analytic companies that can provide you that with that information. Chris, I just wanted to hand it off to you just quickly if you have any other further commentary on this page.
Thanks, Carl. A couple of things. One, the concept of getting ahead of a story. I mean, we talked about this a little bit in the first part of the webinar, but when there are issues at the hedge fund or in the market, like there was in 2008, one of the relationships that's in the left box is, the credit department, the hedge fund credit group, and the like. And it's really important when there is uncertainty in the market about your fund or about hedge funds in general or your strategy or the like, for you to get ahead of it, as Carl put down here in this slide, and be proactive in contacting them and making them aware of your situation, whether it's good, whether it's bad, or something in between. Because as we talked about earlier, uncertainty about you will always be perceived negatively. And even if you have not a great story to tell, getting it out there provides a level of trust, a level of transparency with the credit department. And if you're not the only group that or hedge fund that they're looking at, like in 2008, it takes you off of the list, right? Now they'll start focusing on other funds that they haven't heard from. So it never hurts to get ahead of that. I think the other thing we're going to be talking about in the next few slides is just the importance of an ongoing discipline of relationship management, due diligence, ongoing monitoring. These are things that just have to start to be ingrained into your organization as best practice, as a way of just conducting business. And I know we're going to be talking about this repeatedly, that this isn't kind of an ad hoc thing or a one and done type of a thing. This is something that has to be done on an ongoing basis, because everything is changing. You're changing, the bank is changing, everybody's in a constant state of change, and you have to be current. Carl?
Yeah, it's a good point. And I think, when you look at communication reporting, it's also about creating qualitative communications and having them frequently. As Chris alluded to, this is not a one and done proposition. This is not, I have the org chart and I'll never talk to these people ever again. This is maintaining a dialogue with credit and risk officers as a key component, but also some of the other areas that may affect your business. And creating formal discussions is important because it provides comfort on both sides, as Chris alluded to. Make sure that those discussions have an agenda. Make sure that those discussions are periodic, whether it be on a quarterly basis, on a yearly basis, whatever the frequency. Make sure that there is an agenda as to what you want to talk about and learn from each other in this communication side of the equation. Transparency is a good thing. Whether it's good news or bad news, it's important to provide it. And transparency goes both ways. As changes are occurring at, let's say, a prime broker or an OTC counterparty or a bank, it's important to have somebody that you can call and pick up the phone and say, hey, what's going on with your firm? We've gotten a lot of inquiries about Credit Suisse, obviously. What are they going to be looking like in the future? How are they going to be managing their business? Are they still going to be in prime brokerage? These are all questions you should be asking Credit Suisse. We can give our opinions on it, but having that direct dialogue is a key component to being successful in your communication reporting angles. We talked about getting ahead of the story. And we also should develop a plan as to what information is required of all parties. What are you looking for? What's the story that you want to tell? And conversely, how are the counterparties providing you with the information that you think is important? It's important to develop some standards and best practices that are important for your business. What is important to you? What makes sense for you to track and manage? Make sure that those qualitative points of light are always monitored and managed on a periodic basis. Chris, any further commentary on this? Chris, mute. You muted yourself again.
There we go. Now I'm back. It's interesting you mentioned that point about, making a call to find out what's going on with your counterparty. During the crisis in 08, 09, there was frequent questions about banks and their ability to fund themselves. And hedge funds called frequently on this topic, and those that had a relationship and the ability to get on the phone with the Treasurer of the Americas at Deutsche Bank at the time, got a high level of transparency from that group and from that person. And so I think when you have a discipline to kind of develop these relationships and know, not just develop the relationship, but know who to talk to depending on what topic you're interested in, who does what in the organization, to get the information you need most efficiently. And that was one example from past crises where that was extremely, the hedge funds that kind of had that aptitude were able to get in and get the information they wanted.
Good point, Chris. Let's move on to our first polling question. Who is more important to you as an investment manager? Your investors, credit providers, relationship managers, or all of the above? Please vote. Don't be shy. Not surprisingly, many people said investors or all of the above. It's sort of a kind of a trick question. They're all important. I think one of the things that is important to note is that there's two lifebloods to your business as an investment manager: your investors and the people who extend you credit. Without those two, and without them being efficient to manage the strategies and understand your business, you don't have a business. So they are all equally as important. Obviously, investors for the investment side, but credit providers for the extension of credit that we all expect as investment managers. Let's move on. Now we're going to talk a little bit about relationship management. And one of the things that I think is important to understand is we've seen this so many times before. 2008 aside, establish backups for your primary credit providers. Can't tell you how many times where firms have gone back to investment managers and said, we can't really extend the same kind of credit, or, we have to limit your lines, or we have, some problems with extending credit for these types of investments. It's always important to develop relationships at other counterparties. Even if you're not doing business with them, it's important to do so. And I think senior relationships with your counterparties and monitoring how that's changed over time is extremely important. There's a musical chairs that goes on with a lot of the banks and the players in certain seats. And understanding those changes, I think, are very important. It could affect your business to a great degree. And as we alluded to in the people side of the counterparties, make sure you establish relationships with all of the decision makers. And if there are gaps in understanding or who the players are that affect your business, make sure you develop a plan to cultivate those relationships within those organizations. Chris, I'll turn it over to you to talk a little bit more about this particular slide.
Thanks, Carl. Yeah, monitoring, actively monitoring, your relationships at your providers is best practice, and it's not just the senior people at the hedge fund versus the senior people at the bank. Everybody in the hedge fund organization should line up against somebody at the bank or the financing provider, or they should know who they line up against. When I was at Deutsche Bank, we actually did this in reverse. We had a process where we said, okay, who do we need to know at the hedge fund, right? And who should know that person at the hedge fund, and do they know them, right? And once you've established the links, we call this kind of a relationship mapping exercise. Once you kind of understood who you lined up against, the next thing we say, well, do I have a relationship with them? How good is that relationship? Does it exist at all? And then they would come up with a plan. If it wasn't, a solid relationship or an established relationship, then the next step was to come up with a plan. What are you going to do over the next 6 months to get to know this person, right? Meetings, lunches, whatever, phone calls. What are you going to do that? And that has to be done on kind of an ongoing basis, because again, there are changes in organizations that are happening all the time. Today, right? The news came out about JP Morgan, a big leadership change over there. Their co-president is retiring. The CFO is now going to become co-head of the consumer business with Marianne Lake. And another person is coming up out of the investment banking world to be the new CFO. Now, again, people don't have relationships necessarily with all these senior people, but let me tell you, when something that big is going on, there's a lot of other things going on underneath the covers further down the organization that could be part of your world, right? So the thing I would just add to Carl's opening points here is that you have to sort of take an active interest in your counterparties organizations, right? And be kind of just thinking about, what's happening there, what's new there, what's changing there. And that will help you kind of have kind of your antenna up and be sensitive to how these changes might affect you going forward. Carl?
Yeah, I mean, one other point on this slide I think is important is that similar to investors where you have a pipeline of potential investors for your fund, you should also have a pipeline of counterparties as part of your CCRM program. Because as changes occur, maybe it will affect your business to a degree where you need to look elsewhere. And this has happened many times before. It's that person that you had the ultimate trust in just got laid off, or the business that supported you, let's say financing for esoteric stocks, they no longer provide. All of these things will signal to whether or not you need to look at others for potential pipeline of credit counterparties. And just one other anecdotal notation here. We have an analytics company that does analysis on all the registered investment advisors. There's over 40,000 of them. And one of the things that was striking was that the number of quote unquote prime brokers, you would think prime brokers is a couple dozen, right? There's over 350 entities that are named as prime brokers in the registration filings for these 40,000 some odd registered funds. So when you think about understanding where you can go for some pieces of your business or all of your business or a slice of your business, keep that in mind, because there's plenty of places to go to get counterparty credit in other areas, in other firms. Paul, is there anything else that you want to add to this slide? Unmute.
Thanks, Carl. Yeah, continuing on the theme that this is a dynamic business and that your terms and conditions of the relationships with your counterparties change from time to time, you should make it a point to be in touch with your insurance broker most every one of these third-party contracts, counterparty contracts, are going to have insurance provisions. And to the extent that they change, you want to make sure that you're in line with those contracts. So in the hopefully unlikely event that as a result of one of these relationships, a loss is generated and a claim happens, that you're you're in line with the expectations of that counterparty. And also talking about the idea that, if there's stuff in the press, assume that the underwriters will have seen that as well, and try and get in front of that story. So whether it's good or bad, because like you said, the bad or the unknown will be perceived bad with the underwriters. And as brokers, we want to get in touch and put you in the best possible light with the underwriters that are providing coverage in your tower.
That's a good point. I mean, most people don't think of insurance as a credit provider, but they actually are in the sense, and they do similar due diligence, and they should not be overlooked as events occur as well. Okay, let's do our second polling question. Do you have a formal process in your firm for monitoring organizational changes at your financing counterparties? A simple yes or no will suffice. Okay, pretty much split. Not a lot of respondents, but pretty much split, which is considered appropriate for the audience. I think what we have found is that many of the larger organizations will have to do this because there's so many people that they face off with. But even in smaller organizations, understanding who these players are and how they change over time is going to give you a leg up on making sure that your business is sound with those counterparties, for sure. Okay. Who are the most important people that you need to communicate with? It's important to understand if there are different relationships outside of prime brokerage, that you get to know those players as well. The credit risk officer for prime brokerage may not be the same person that handles your OTC business or handles your repo business. And so if there are varying places where you have touch points, that you understand who these people are and what their focus is, and get to know who they are. Trading groups obviously extremely important because if you're doing business in 4 or 5 or 6 different jurisdictions or areas of a bank or a broker dealer, all those trading groups report into somebody for credit and risk. And if they're different, guess what? You need to get to know them as well. Chris can talk a little bit more about practically how do you go about doing that. So Chris, you want to talk a little bit about that?
Sure, Carl. I think, the other thing I would mention in this is that we're talking about relationship management from the hedge fund's perspective, and how the changes there can be, create risk for them. But depending on the size of the fund, changes at the financing counterparty, bank, broker, whatever, can create risk for them in terms of relationships that they have, right? I'll give you an example. I was meeting with a client a number of years ago, and one of the things I do when I meet with them is I say, "Oh, let's go over your prime brokers. Who are you using? I know, who's your lead, who's your second, who's your third, whatever." So we went through the list, and I said, "Well, the 4th prime broker, they used to be your first prime broker. Why are they so low on the list now?" Well, he said, "Well, they lost a lot of senior people recently. They lost people that knew us. So until we get to know the new people there, we're dialing back all our exposure with them, because people there don't know us anymore." So to one of Carl's earlier slides, and what we talked about in the part 1, is that transparency goes both ways, right? And the impact of organizational changes goes both ways, right? So for the larger funds that have a lot of exposure to specific financing counterparties, they will perceive these changes quite negatively and will de-risk themselves, so to speak, with that prime broker or financing counterparty until they can recalibrate their relationships, right? Get to know these people. This is a real, this was an example of this in real time. You know, they were saying, well, we're just not going to take the chance here. If a crisis erupts while we're still exposed here and all our people are gone, they don't know us, right? That could be detrimental to us. So it cuts both ways. And again, to talk about the process again is knowing who are the players you need to know. Who are they? And this is, and this is not an insignificant exercise, right? Because if you are a reasonably sized hedge fund, you have multiple providers, right? And so this is, 3 or 4 or 5x in terms of the process. And the challenge again is for hedge funds that don't have a lot of people, don't have the resources that, let's say, a much larger hedge fund would have, is they have to come up with a process. They have to right size it in a way where they can still do this in a way that they can manage based on their size, right? And that's always the challenge with all the things we're going to talk about today, which is right sizing it to your organization so you can get it done in an efficient way. It doesn't have to be as robust as the much larger funds, but it has to be done in some fashion. Carl?
Yeah, I think that's a good point. That's something that we'll cover in great detail in part 3. How do you right size it, regardless of your size? What makes sense for you to look at? I think one of the simple things, to Chris's point, is, having an org chart of all the areas that you touch upon. Who are the players that you're trading with? What are their reporting lines into middle and back office, into credit and risk? Where do they roll up to? I mean, something as simple as getting an org chart can give you a good sense as to the depth and breadth of a particular organization and whether or not you have enough relationship power within that organization by understanding where all the points of light are with people. So, I mean, that's a very simple example. There are other metrics that we'll talk about, but that's one of the things that I would suggest is one of your first go-tos, regardless of size.
And Carl, that's one of the things that I do for certain of my clients as well, is maintain org charts for their prime brokers, and it's one of the more popular things that I do for them. They really appreciate that because it takes some time to do it and put it together and the like, and it gives you. It also, the other thing about an org chart is it's a visual, right? It's not just a list of names now. It's also kind of three-dimensional. You can see where everybody kind of sits, hierarchically, and that's helpful as well.
For sure. Okay. Let's move on to due diligence on counterparties. What is our objectives and fundamental concepts that we need to do in order to have proper due diligence on counterparties? Well, the first and foremost is that this is not a check the box exercise. It's not a one-time thing. What you'll find over time is there will be trends with providers. There will be businesses that they get in and out of. There'll be times where there will be changes to personnel, but there will also be service changes. What you're trying to do is you're trying to create a picture of the overall organization and its applicability to your business. One of the things that I hear often is, well, I mean, Goldman Sachs is too big to fail, right? So why should I be concerned about doing any counterparty credit due diligence? Well, are they too big to fail, or are you too small to service? Invariably, we've seen this many times before, firms, counterparties, credit counterparties can put you out of business, probably in lesser degree to some of the things that we've seen recently than the reverse. And, a clear example of that is, post 2008, when you had all sorts of financing issues around a variety of different elements. One of the things that struck me is I had clients calling me about their convertible arbitrage business. that their prime brokers no longer wanted to finance convertible arbitrage. Okay, if you're a convertible arbitrage fund, where are you going? Who's going to take that business? Understanding that you may be too small to service, and what are your backup plans in order to facilitate that? Balance sheet impacts, legal entity structures. Where is your business? Many times there are sub entities, and I think I quoted a stat on the first part that talks about the number of sub entities that prime brokers have. It's in the hundreds. So where is your business located? Is there a parent guarantee attached to it? What are the reporting lines? Goes back to the org chart. Where does this roll up to in the scheme of their legal entity organization? And how has the counterparty changed over time in its various business? Sorry, I went too fast. Paul, I'm going to turn this over to you because I think this holds true on the insurance side as well. What is your perspective on this?
Thank you, Carl. Yes, not unlike, in the broker-dealer space or the prime brokerage space, fund administrators, whatever, individuals change on the underwriting side of the insurance business. And particularly for smaller firms, if you feel you're too small to service, it makes it much more relevant for you to get out in front of your underwriters. I like to put underwriters, my clients, in front of the underwriters when we're doing renewal meetings or we're having a claims discussion, so that both sides can get together and understand where the exposures are. You don't want a fund that doesn't have best practices, best coverages available on the street. Underwriters don't really nitpick the size to give you fund coverage, good coverage or not. Pricing and retentions are going to change. But unless you put yourself out there and advocate for yourself and have your broker advocate for yourself in the insurance space, you won't necessarily get the best deal to protect your firm.
Yeah, I think also understanding the entity structures is equally as important on the insurance space, right?
Absolutely. You want to have the org chart always updated and in your broker's hands so that he can in turn distribute that to the underwriters so that those entities are picked up for coverage if there happens to be a loss confined to a specific entity. You don't want to be excluded from coverage because that entity was not scheduled on a named insured list.
Good points. Chris, any else to add?
Sure, Carl, thank you. We do a due diligence annually, or we suggest that a due diligence be done annually across all of your financing counterparties. And it's important to first define the objectives of a due diligence project or exercise. 95% of the exercise is really confirming and verifying and updating information about the counterparty. How have things changed since the last time you did your due diligence? And a lot of this is not very exciting stuff, right? But what you're trying to find out is, have processes changed? Have investment in the business changed? Oh, there's a whole host of things that we look at. It's counterparty credit risk, but it's also a continuum of risks that we look at. So 95% of what you're doing here is just kind of getting yourself current, right? And then probably 5% or less you're going to get responses that are outliers on either a relative or an absolute basis, right? Which demand more inquiry. In a due diligence exercise, you're probably not going to get the counterparty to tell you something that is very controversial or provocative, right? Because they're not going to do that to themselves, right? But what you're doing here is you're mostly just trying to get yourself a current picture, and then take that data, all the responses that you've got, and then try to paint a picture, as we were talking about earlier. Connect the dots. What is all this saying about the major categories of due diligence that you're doing? And what does it tell you about the firm from a trend perspective about where they're going across the various topics that you're interested in? And lastly, I would say that The challenge with due diligence is that it's a very time-consuming exercise. It takes about probably start to finish 4 to 6 weeks, right? And most fund managers do not have the capacity. Let's not even talk about the expertise, because a lot of them probably have a fair amount of the expertise to do it, but they don't have the capacity to do this. And that is where firms like mine and Garl's and Paul's come in, is that we provide the capacity to do this. You know, I can't tell you the number of times in my bit when I was in the business where someone would come to us, a hedge fund would come to us with a due diligence questionnaire. We'd fill it out and send it back, and then we'd never see another one again, right? And we'd ask, "Are you doing it this year?" No, we got busy. We didn't, you know, we had other things going on, and that's where you kind of lose the thread of the ongoing discipline for doing it, because it doesn't work unless you do it all the time. Carl?
Yeah, that's a very good point. Again, in part 3, we'll talk a little bit about how you pull that all together, regardless of your size. One of the areas of due diligence is clearly going to be their service capabilities. And I think this is important. When you first look at a relationship, a new relationship, excuse me, you want to look at the basic services that fit your strategy. Excuse me. But after that, you know, when you go beyond the basics, are there services in the pipeline that they have that complement your growth? You know, as an example, if you were comfortable with getting Reg T, but now you need something a little bit more, with a little more leverage gearing, do they have arranged cross margining? Are they good at securities lending on hard to borrows? Is there an asset protection program for your fully paid for stocks and securities? Do they have competitive rates? How are they compared to others? These are all due diligence questions on the service side that absolutely change over time, and it's important to understand that and how the basics and beyond the basics can morph into something that's compatible with your business or not. Chris, any other commentary on this?
Sure, Carl, thank you. As I mentioned on the previous slide, due diligence, my approach to due diligence is, as I said, along a continuum of risk, right? There's counterparty credit risk, but there's also operational risk, there's regulatory risk, there's liquidity risk, there's information security risk, which includes cybersecurity as well. These are all things that can materially disrupt your business if they go wrong. And, you know, and it becomes a cycle of due diligence, right? You do your due diligence exercise, you get the results, you analyze the results, and then that kind of, from that you adjust and recalibrate your view of your counterparty, right? And then you do it again next year, and you recalibrate, and you start to see the trends there. What I have been asked lately by folks is, would the due diligence process have caught Archegos? My view on all sorts of due diligence, the annual as well as what we're going to talk about in a couple of minutes, is that it's more about preparation than prediction, right? However, that said, I can tell you there are examples where we have done a due diligence on a counterparty and we've seen things like a reduction in investment in the business. We've seen them losing key staff, right? Now, this doesn't necessarily, you know, help you catch a situation like that, but it does start to create a trend line which says this is a firm that is underinvesting. This is a firm that has lost key people, right? This could present issues in all sorts of ways, and certainly Archegos is one way that this manifested itself. So, you know, the due diligence allows you to be prepared and to analyze information and to assess potential risk, right? How the risk actually ultimately manifests itself, no one can know. But the due diligence process will give you information to get some early warning signals that things need to be watched more closely at a given counterparty.
Yeah, I think we can easily say that as we hear this all the time, prime brokerage has been commoditized. It's still a lending business, and lending business has risks. And if you don't have the right people in the seats, as an example, to bubble up those risks to senior people, then what invariably happens, and if those people have not experienced, events in the marketplace, invariably things go awry. In the case of let's say a Credit Suisse or anyone else, the reality is that there are metrics to understand that we'll talk about in our counterparty metrics section, where you can do an assessment of those counterparties through analytics that the street has, and that should be something important that potentially funds look at, because that's where you can get these signals and you can understand the trends in rating from last year to this year, or from this quarter to that quarter. Paul, I want to touch upon the insurance aspect of things, because I know this is an important aspect at Alliant.
Thank you, Carl. Yes, it's important to establish capabilities within your brokerage. Since a fair amount of risk happens offshore, you want to make sure that your brokerage, your insurance brokerage, has access to those markets, whether it's UK, Ireland, Eurozone, Hong Kong, what have you, that there are people on the ground, that there are direct relationships, that they don't have to scramble if something is happening outside of the United States. I think that's very, very critical. And also on the claim side, when you have claims, what happens at the broker? Is the broker just going to wait for your inside and outside counsel to provide some diligence so that they can deal with the insurance carrier? Or are they providing their own legal advocates to work with your inside and outside counsel to take you out of the loop, to allow you to manage your business and not be too involved directly in the claims process? I think these are things to ask the questions of before you execute relationships with any brokerage, but certainly on the insurance side, since it's a global business, you want to make sure that you have as much activity outside the US as you have internally, and that activity can be covered appropriately.
Good point. So let's go on to what I think is one of the things that Chris certainly focuses on a lot of, is the counterparty metrics. And part of your due diligence is I'm always surprised at long short hedge funds who do fundamental analysis on companies don't do the same on their credit counterparties. It's kind of baffling to me, but the bottoms up fundamental investment analysis approach is really very similar. What does their business look like? What is their management style? Do they have the right key people in the seats? If I was investing in this company, would I be long or would I be short? All of that fundamental analysis, I think, is extremely important to add. So if you're a long short, or you're someone that does fundamental investment analysis on companies, you certainly could leverage your analysts and your PMs to provide you with the same kind of metrics that they do on companies they want to invest in. I think there's an important aspect of understanding your counterparty is cataloging and understanding the regulatory violations and positive and negative news that's out there. Regulatory violations means something has happened in the past, and if finally they got dinged for it, which leads to potential trends that you may see in a counterparty. If they have violations surrounding, let's say, securities lending and not having coverage for securities that they're supposed to be lending to you, as an example, well, that's a red flag that you should be clearly mindful of as to whether or not, they're doing the right thing. And if you do have a situation where an event has occurred, it's always nice to pick up the phone and speak to somebody. So knowing who that person is, who can explain the story, explain the reasons behind what's going on, is something that we've talked about for this whole presentation. CDS ratings and stock price are clearly important, not the only drivers, but you can get some sense of what the market seems to think about your counterparties, any regulatory changes that have occurred. Chris can talk a little bit about that. Consensus ratings. There are vendors who compile consensus of your counterparties from the credit people who actually do the analysis at these same banks. It's a combination of a lot of analytics. You'd be surprised how different the ratings look from firm to firm, but coming up with consensus ratings that are not just the Moody's or S&P ratings, but something that credit people are actually doing gives you some insight into where they're heading and how the street looks at them. Peer group assessments. This is a to and fro process. It's always nice to understand how you line up with other peers in terms of, the amount of people and dedication to certain areas of the firm, non-investment professionals. Are they using the same kind of counterparties as you are? That's always important to understand and know. There are analytics out there. Again, I mentioned this, where there's over 40,000 registered investment advisors who have to provide certain information. You can see what people in your peer group, how and why they're using certain counterparties. And also, the reverse is true. You can do peer group assessments for counterparties through this analytics tool and understand what their business model looks like, not what they tell you. And then, the important thing is to look at these trends over time and be able to understand what is your allocation methodology. If you have more than one prime broker, if you have more than one OTC counterparty, if you're in a business that's heavily related to FX or futures, how do you allocate your business? What are the drivers that make this important to how your book is broken up into various counterparties? There should be allocation business methodologies that you create that allow you to set the rules of engagement, and then of course the big challenge is making sure you follow them. Chris, any other points on this slide?
Sure, Carl, thank you. We've obviously moved from the previous slide, but kind of talking about kind of the annual process we go through, and now we're kind of into the day-to-day and other periods between daily and annually. And a couple of things that I look at a lot are not just the metrics of the counterparty, but also the environment that affects the counterparty, and in that case, the regulatory environment, which since the crash of 08-09 has become a part of every counterparty's life on an ongoing basis. So I'm always monitoring on my client's behalf what's going on in the regulatory front, whether it is the most recent example of the supplementary leverage ratio relief being that was put in place in March of 2020, being allowed to expire at the end of March, right? Which was a big deal to the banks because the SLR was intended to be the backup to the main capital ratio, CET1, but the SLR falls more heavily on prime brokerage. So the banks were against, were lobbying the Fed to extend the relief, and the hedge funds needed to be aware that this will fall more heavily on them. So we look at all those types of things that are going on in the regulatory front on a quarterly basis, and by looking at the news on a daily basis of what's going on and monitoring the changes that are going on and that can affect the hedge fund, right? Because it affects the bank, then it affects the hedge fund. It's kind of a link there. And the other point I'll make is that we try to look at the metrics themselves on kind of a rolling 4-quarter basis, right? You know, most of these metrics come out quarterly, the big ones that you look at, capital, liquidity, and things like that. But we try to do it on a kind of a rolling 4-quarter basis so you can see trends, you know, what's going on with capital, with liquidity, with funding, with profitability. So we think that's important, and it also gives the hedge funds a reference tool to use between quarters, right? Because, you know, like a question comes up during the quarter since the last reporting, say, you know, there's a capital issue, there's a liquidity issue. They can just go to these reports and look at them and say, well, wait a second, I've got the information right here. I know what's been going on for the last 4 quarters for the LCR or for CT1 or whatever. So it's important to create that kind of picture where, you know, you're not just looking at one metric for 1 quarter, but you can see back, you know, to see the trends that are going on. Carl?
Yeah, it's very important, and also it plays into how you go about allocating your business, as we mentioned before. You know, what are those important drivers that are going to change? In Chris's scenario, the relationship that one of his clients had with a particular bank changed, and that was a major driver for them. It could be leverage, it could be trading expertise, it could be the research that you know, is allocated to your fund that may have changed or is being enhanced. All of those factors will come into play on how you allocate business. Okay, we're getting close to the end here, running out of time, so I'm going to blow through this real quick. And this is just really to give you a sense of what kind of due diligence timing is necessary. There's daily, quarterly, and annual. Chris has already talked about the annual. The quarterly portion of it is some of the things that we touched upon already. I would be mindful that all of these need to be done in conjunction with a story that needs to be told. Chris, do you want to add anything else to that?
Carl, I think this is just a good final example of how due diligence is an ongoing process, right? It happens every day. It happens every quarter. There's something that can be done on an annual basis. There's something to be done when you're deciding on a new counterparty. So due diligence is part of the fabric of a hedge fund's, you know, conduct with their counterparties. And I think that's the one thing that if there's one takeaway from this whole thing is that it is just an ongoing process that needs to be incorporated into each hedge fund's organization.
Okay, so in summary of everything that we've talked about today, obviously get to know and understand the key players at your counterparties. This is an active management and ongoing due diligence process. Understand the trends over time. This will provide you insight as to how you allocate business. Understand how the service offering is being developed or changed with your counterparties. Define the metrics that are important to your business. If relationship management is the top of the list, then obviously that's one of the metrics that you need to manage. Create the standards that you think for periodic analysis and stick to them. The example that Chris mentioned about you know, firms having a situation where they didn't stick to their knitting is extremely important. And you know, the key component is that, you know, CCRM is about telling a story for each counterparty, and this is part art and part science. And the art part is being able to weave all of those disparate points of data and create a storyline that informs you as to how you want to move forward with your business with those counterparties. So I want to thank everyone for attending. This will be available through digital means. Please feel free to reach out to any of us. Part 3 will focus on putting all of this together. And we thank you for your attendance for this particular webinar. Thank you.
Thank you.
Thank you, everyone.